Alright guys, so a lot of people have bond ETFs in their portfolio, which are deemed to be relatively safe, but I wanted to take the other side of it and kind of show you why that might not be the case. To start off, we'll analyze a bond that matures in 5 years, and then we'll take a look at one that matures in 10 years. So here I'm just going to do a little formatting. So first we need a discount factor. We'll set that equal to 5% now. We need a coupon rate. We'll set that equal to 5% as well. And then the face value of the bond, which are typically 1,000, so we'll do 1,000 for this example. Now for years 1 through 5, we can expect this bond to pay us 5% of the face value each year. 5% multiplied by the face value. I'm going to lock those cells. So that's $50 each year for 5 years. And then in the last year, we're going to add 1,000. Now to get the present value of the bond, which assimilates that bond ETF's price, we need to discount each year's cash flow. So to do that, I'm just going to divide the cash flow by 1 plus our discount rate raised to that period. Do that for the rest of these cells. Now I'm going to get the sum of these cash flows. So the present value of this bond is $1,000. Let's take year 5. So I'm basically saying I'll let you borrow $822 today and you'll pay me back $1,050 in 5 years. So I'm just going to copy this to get our 10-year. I'm going to drag these all the way over here, at our face value here. I'm going to discount these, and I'm going to sum this cash flow. So in both instances, you see that the present value is equal to our face value. That's because our discount rate is equal to our coupon rate. Let's say you invest in a bond ETF that has a higher coupon than a competitive ETF. Now you're paying more for that ETF because you're getting a better rate than the competitors. And if we take a look at the other way around, if you invest in an ETF that has a lower coupon rate than its competitors, you'll get to buy that ETF at a discount. And the coupon rates, you can think of these as the cash flows you're receiving from this bond ETF, kind of like a dividend. But let's see what happens if we drop this market rate down to 0. Our prices shoot up. So I think this is happening to all bond ETFs and have been a relatively safe investment in the past years, because if we take a look at the 10-year treasury, we have seen nothing but declines ever since 1980, and we're sitting at all-time lows. And we can probably expect to see this rate closer to 0, at least in the short term. But I wanted to kind of go over what's going to happen to these ETFs if this 10-year treasury yield decides to spike up. So we're currently near 0, right? But let's say, as an extreme example, they shoot up to 10%. This present values, you can think of it as the current market price for this bond ETF. And we change that market rate to 10, all of a sudden these prices drop. Now what can we do to kind of salvage our investments? One thing we could do is move away from longer term bond ETFs to shorter term ETFs. An example of a very short term ETF is the Spiders BIL. And here we have the top 10 holdings for this bond ETF. It's made up of treasury bills that will mature in less than 3 months. So in the case of an increase in interest rates, you can move into this ETF, because once these treasury bills mature, they'll get replaced with newer ones with higher interest rates. And this will kind of keep the level on as far as the price. And I would recommend you staying away from those longer term ETFs, kind of like TLT. So these are sorted by maturity. and the one that actually matures next won't be until 2036. So we have to wait until 2036 until this treasury bond gets replaced. So in essence, these longer term treasury bond ETFs are more sensitive to interest rates, and we could kind of notice that by observing their betas. So here for this 1 to 3 month ETF, beta is closer to 0. And if we take a look at the TLT, our beta is almost 3. So 3 times more volatile than the market. So again, I'm not saying that we're going to see an increase of interest rates anytime soon, but when this happens, at least you'll get a notion of what to do when it does happen. And kind of to illustrate the sensitivities, I created this spreadsheet. This is a bond with a face value of 1,000 that pays $100 each year. And here we see the discount rates at 1 through 5%. Here are our years. And if we take a look at the very short term one, if we were to have a discount rate of 1%, all of a sudden shoot up to 5%, we will see a decrease in price of closer to 4%, and vice versa. If we see a discount rate of 5%, and all of a sudden it drops down to 1%, we'll see an increase of that bond price of approximately the same, roughly 4%. Or if we take this 20-year bond and it's currently trading at a discount rate of 1% and interest rates rise to 5%, we'll see a drop of closer to 40% in price. And the other way around, if we see if we're currently at a market discount rate of 5%, discount rate drops down to 1%, that bond price will increase to almost 62%. So again, this is kind of to visualize what's going to happen to those longer term bond ETFs compared to those shorter ones. And since we're currently trading closer to 0, and we can expect that to be the case for the upcoming years, but when they do rise, you will want to get out of those longer term bond ETFs and move into the shorter ones. Alright guys, we'll hope that helped. Let me know if you have any questions. And as always, thanks for watching.